Today, we're doing a complete breakdown of Indian Accounting Standard 109. We'll cover the scope, core principles, measurement, journal entries, and real interview questions. Whether you're studying Indian Accounting Standard, prepping for a Big Four interview, or working in finance, this is everything you need to know. Back in 2008, financial instruments were like ticking time bombs, misunderstood and misclassified, leading to a global financial meltdown. Indian Accounting Standard 109 reshaped how these instruments are recognized and measured. By the end of this section, you'll grasp how this standard provides clarity and stability to financial reporting. Indian Accounting Standard 109 emerged from the chaos of inconsistent accounting methods for financial instruments, which left investors in the dark. It tackled this by providing a consistent framework, focusing on classification, measurement, and impairment. By aligning with International Financial Reporting Standards 9, it enhanced global comparability, offering a clear view of financial health no matter where a company operates. Indian Accounting Standard 1099 became mandatory for all listed companies and significant unlisted public entities in India from April 1, 2018. The critical requirement is classifying financial assets based on the entity's business model and the cash flow characteristics. This transparency ensures stakeholders can make informed decisions, knowing the financial instruments are reported accurately and consistently. The Financial Instrument Classification and Measurement Model in Indian Accounting Standard 109 classifies financial assets into categories like amortized cost, FVOCI, and FVTPL. These classifications depend on the business model and cash flow characteristics. For instance, FVOCI lets you see fair value changes without impacting profit or loss directly, while FVTPL reflects real-time market values. This approach ensures financial statements truly represent an entity's financial position, a crucial insight for interviews and real-world applications. Understanding the scope of Indian Accounting Standard 109 is vital for accurate financial reporting. A frequent mistake is assuming insurance contracts fall under this standard. Interviewers love to test this, so knowing the exclusions can make or break your interview. Dive into which assets and liabilities truly belong here. Indian Accounting Standard 109 applies to various financial assets and liabilities. This includes cash, loans, and receivables, impacting how they're recognized and measured. Equity instruments like shares fall within its purview, affecting investment valuations. Derivatives such as options are also included, highlighting their fair value implications. Understanding these inclusions is key for precise accounting. Indian Accounting Standard 109 explicitly excludes certain items, like insurance contracts, which are governed by their own standards. Lease contracts are another exclusion, as they fall under different guidelines. Employee benefits are not considered under this standard, reflecting their unique accounting needs. Tricky interview questions often target these exclusions, so knowing these boundaries is crucial to avoid common pitfalls. A financial instrument is fundamentally a contract that results in a financial asset for one entity and a liability or equity instrument for another. For instance, when a company issues a bond, it creates a liability for itself and an asset for the bondholder. This definition is central to identifying what falls within Indian Accounting Standard 109, impacting how such instruments are reported and analyzed. Amortized cost is key for financial assets and liabilities, initially measured, then adjusted for repayments and amortization. Consider a bond issued at $1,000 with a 5% interest rate. As interest accrues and principal is repaid, its book value changes. This method, crucial for reflecting the true economic cost over time, aids in accurate financial analysis and reporting. Navigating scope edge cases can be challenging. For example, a loan commitment falls under this standard only if it's derivative. Contingent consideration in acquisitions is covered if it's a financial instrument. However, prepaid expenses and deferred revenue don't qualify under Indian Accounting Standard 109. Mastering these nuances ensures precision in financial documentation, a critical skill for any finance professional. In the corporate world, accurately valuing financial instruments is critical for transparent financial reporting. Indian Accounting Standard 109's core model provides a structured approach to ensure financial instruments are classified and measured consistently. This creates clarity in financial statements, especially in complex scenarios involving multiple instruments. This model tackles the challenge of classifying and measuring financial instruments with precision. With Meridian Corporation's $10 million SaaS contract, we explore how the model applies to a real-world scenario. By dissecting each component, we ensure the financial statements reflect true economic value, enhancing transparency and consistency. Meridian Corporation's contract involves identifying the software license and implementation services as part of the financial instrument. This first step ensures we capture all relevant components. Common errors include confusing non-financial terms as financial, which can skew classification. Proper identification sets the foundation for precise classification, crucial for subsequent measurement. Continuing with Meridian Corporation, the classification decision is crucial. This step requires understanding whether the $10 million agreement aligns with amortized cost or fair value models. Missteps often occur when the cash flow characteristics or business model are misunderstood, leading to incorrect classification. Aligning the classification with the intended cash flows ensures accurate reflection in financial statements. For Meridian Corporation, initial recognition involves measuring at fair value if the $10 million components fall under FVTPL. This step is critical, as initial measurements establish the foundation for subsequent valuations. Errors often arise when practitioners mistakenly apply subsequent measurement criteria at this stage. By adhering to Indian Accounting Standard guidelines, this initial value captures the entry price, setting a consistent baseline. As Meridian Corporation moves forward, the $10 million contract's classification dictates its ongoing measurement. For example, any shift in business model could require reclassification. Practitioners often overlook changes in cash flow patterns, resulting in outdated valuations. Indian Accounting Standard mandates regular reassessment, ensuring the financial instrument's valuation remains relevant and reflective of current conditions. Finally, Meridian Corporation must regularly assess its $10 million contract for impairment using the expected credit loss model. This involves analyzing credit risk and potential losses, ensuring asset values aren't overstated. A common pitfall is neglecting early signs of impairment, impacting financial integrity. By following Indian Accounting Standard, Meridian Corporation can recognize and address credit risks, maintaining accuracy in its financial reporting. The measurement method you choose directly impacts your balance sheet. A wrong choice can overstate assets by millions. Indian Accounting Standard 109 allows for options like amortized cost or fair value, but it demands transparency. Disclosing risks and valuation changes isn't just compliance. It's crucial for investor trust and accurate financial analysis. Initial recognition is all about capturing the right value at the right time. For financial assets, start with fair value plus transaction costs. Think about significant influence. This might shift you to the equity method. Trade date is crucial for timing. That's when commitments solidify. For liabilities, remove transaction costs if going through fair value in profit and loss. Remember, trade receivables often get simplified by sticking to transaction price. Ongoing measurement is static under Indian Accounting Standard 109. Financial assets might shift between amortized cost and fair value options depending on your business model. Fair value changes typically hit profit and loss, unless designated through OCI, where equity takes the punch. When using amortized cost, apply the effective interest rate method for precision. Reclassification needs a significant business model shift, not just a tweak. Think of it like changing lanes, not just adjusting your speed. Presenting assets and liabilities under Indian Accounting Standard 109 demands clarity. Your balance sheet should clearly show financial assets as current or non-current, depending on liquidity and strategy. Fair value changes influence profit and loss, or OCI, while amortized costs tweak income lines. Detailed notes are non-negotiable. Investors need to see your valuation methods. Derivatives often get their own spotlight due to distinct risk profiles, ensuring no surprises for stakeholders. Disclosures under Indian Accounting Standard 109 aren't just checkboxes, they're critical insights. The fair value hierarchy isn't jargon, it's about showing reliability of your valuations. Risk disclosures cover credit, liquidity, and market exposures, essential for real risk assessment. Impairment goes beyond numbers, it's expected credit losses, showing financial health. Reconciliation details movements from opening to closing balances, fostering transparency and boosting investor confidence. Remember, these aren't just rules, they're your narrative. Imagine a CFO handling Indian Accounting Standard 109 with precision. They might opt for amortized cost on $10 million bonds to show stable financials. A $5 million equity investment could go through OCI, absorbing volatility without profit and loss disruption. Reclassifying a $3 million asset isn't casual. It follows serious business model shifts. Disclosures aren't just formalities, they shape the financial narrative, offering investors a detailed look at risks and judgments. This isn't just theory, it's the CFO's strategic toolkit. Meridian Corporation, a global manufacturing company, signs a 5-year operating lease for its Singapore warehouse. Watch how every accounting event plays out. Meridian Corporation records the bond under financial assets, as required by Indian Accounting Standard 109. The initial recognition at fair value ensures that the asset is properly accounted for on the balance sheet. This transaction impacts Meridian's liquidity, reducing cash but increasing financial assets. Recording interest income is critical under Indian Accounting Standard 109, which mandates recognizing interest using the effective interest method. Meridian's accrued interest increases both its assets and income, reflecting the bond's performance in financial results. This entry ensures that the interest earned is captured in the current period. Under Indian Accounting Standard 109, adjustments for fair value changes impact other comprehensive income. This fair value increase reflects market conditions and affects Meridian's equity directly, without altering the profit or loss. Recognizing these adjustments ensures transparent financial reporting, aligning asset valuation with current market dynamics. The receipt of interest payment converts the receivable into cash, aligning with Indian Accounting Standard 109's principles. This entry maintains the accuracy of Meridian's balance sheet and cash flow statement, ensuring that cash inflows are correctly matched with previously recorded income. It highlights the liquidity aspect of interest earnings. Impairment testing under Indian Accounting Standard 109 ensures that financial assets reflect realistic recoverable values. Recognizing an impairment loss reduces the asset's carrying amount and impacts profit or loss. This prudent approach safeguards against overstatement of assets, reflecting a conservative valuation in Meridian's financials. The sale of the bond finalizes its life cycle in Meridian's books. Under Indian Accounting Standard 109, derecognition occurs when control over the asset is relinquished. This sale impacts cash balances and removes the asset from the balance sheet, ensuring Meridian's financial position accurately reflects the transaction. Every Big Foreign investment bank interview on Indian Accounting Standard 109 follows a pattern. Here are the 10 questions that come up again and again, with answers that will make your interviewer nod. Indian Accounting Standard 109 is the standard for financial instruments, focusing on classification and measurement. It exists to provide consistency and transparency in handling financial assets and liabilities. A common error is overlooking the importance of fair value measurement. Remember, the standard primarily aims to align with international financial reporting standards and enhance global comparability. Amortized cost is the measurement of a financial asset or liability at initial recognition minus principal repayments plus or minus cumulative amortization. It's used to reflect the real economic impact. Confusion often arises when distinguishing it from fair value. Remember, amortized cost is primarily applied to held-to-maturity instruments. Fair value changes are recorded in profit and loss or other comprehensive income, depending on the asset's classification. This enables a true reflection of market conditions. Misclassification is a frequent trap. Ensure clarity between FVOCI and FVTPL models. Key takeaway: correct classification dictates the recording path. Impairment losses are recognized through the expected credit loss model. This approach accounts for potential future losses, not just incurred ones. Missing timely recognition is a common mistake. Focus on forward-looking information for accuracy. Remember, this model aligns more closely with real-world credit risk. While largely aligned, Indian Accounting Standard 109 modifies some hedge accounting and impairment rules to fit Indian regulations. Misinterpreting these can lead to incorrect application. Always confirm local adaptations. Takeaway: while similar, always verify country-specific adjustments to hedge and impairment practices. Derivatives are recognized at fair value through profit and loss initially. This ensures changes in value are immediately reflected. A common error is misclassifying derivatives as standard assets. Always assess the underlying risk factors. Remember, derivatives need continuous reassessment for accurate financial reporting. Expected credit loss for trade receivables considers historical loss rates, current conditions, and future forecasts. Calculate using a matrix based on aging. Missteps occur by ignoring forward-looking data. Key point: integrate macroeconomic factors to enhance accuracy. Master this matrix method for practical application. Lease liabilities fall under Indian Accounting Standard 116, not Indian Accounting Standard 109. This mistake arises due to confusion with financial liabilities. Focus on categorizing correctly: financial instruments versus leases. Memorize: Indian Accounting Standard 109 excludes leases, directing them to specific lease accounting standards. Disclosures must cover valuation methods, risk management, and hedge accounting impacts. They're crucial for transparency. Overlooking detailed risk explanations is a pitfall. Highlight significant methodologies and assumptions. Remember, clear disclosures build trust with investors and regulators, ensuring compliance and clarity. Fair value represents current market value, while amortized cost involves original cost adjustments. The trick lies in proper classification. Errors occur when not aligning with business models. Remember, fair value suits trading, amortized cost suits holding. Master these distinctions to avoid traps. Understanding Indian Accounting Standard 109 starts with its core objective: standardizing how entities recognize, measure, and disclose financial instruments. It covers financial assets, liabilities, equity instruments, and derivatives, excluding specific cases like certain interests and subsidiaries. Recognizing key definitions like financial assets, liabilities, and embedded derivatives is crucial. These definitions form the building blocks for addressing complex financial reporting challenges, emphasizing clear and consistent application across entities. Classification under Indian Accounting Standard 109 involves determining the business model and cash flow characteristics, leading to categories like amortized cost, FVOCI, and FVPL. Each category dictates specific measurement rules. Amortized cost applies when cash flows are collected, whereas FVOCI is for assets collected and sold. FVPL is for other cases. Fair value measurement factors in market conditions, and the impairment model emphasizes recognizing expected credit losses upfront to reflect potential financial risks. Key interview insights on Indian Accounting Standard 109 include avoiding traps like asset misclassification and understanding its alignment with International Financial Reporting Standards 9, while noting Indian-specific guidance. Grasping derecognition principles, hedge accounting options, and crucial disclosure requirements is vital. Transition requirements may involve practical expedients, affecting initial applications. Knowing these differences and the essentials can significantly impact an interview, showcasing your detailed understanding of complex financial reporting standards. That's your complete guide to this accounting standard. If this video helped you, please like and share. It genuinely helps us keep creating content like this. Drop your standard requests in the comments. Subscribe to Candy Mentor for more accounting and finance videos.